Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, June 13th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you should be making in your portfolio, you need to be a client of 42 Macro. So today's key macro events are the Fed continues playing three-card Monty with markets and disconfirming evidence of our green shoots globally theme. In terms of market implications, the June FOMC failed to provide adequate clarity regarding the near-term outlook for monetary policy. It did, however, support our J1 to soft landing theme by affirming our long-held belief that the Fed has kowtowed to fiscal dominance and implemented a de facto upward revision to their inflation target. That dynamic is structurally bullish for risk assets like stocks, credit, commodities, and crypto, and it's structurally bearish for defensive assets like treasury bonds and the U.S. dollar. That said, investors must respect the evolution of the market regime throughout if they want to maximize upside capture and minimize downside capture in this Fed-sponsored, fourth-turning, perpetuated secular bull market in risk assets. Disconfirming lagging economic data should not discourage investors from anticipating further European equity outperformance over the medium term. The UK, Eurozone, and China all remain in the sweet spot of their respective growth cycles from the perspective of their equity and credit markets. Transitioning to our 42 macro dashboard here, as always, we wrap up with a question from our community. This one's regarding, this was titled Income-Driven versus Credit-Driven versus Both. It says, hello, Darius. I'm seeing understanding from recent slide decks and videos that you believe this is an income-driven bull market. Fair to say that unemployment remains low and payroll is high, that this continues. I'm not sure if I read that. I read it properly, but I'm not sure I understand that. So let me start by saying we do not believe this is an income-driven bull market. We believe this is an income-driven business cycle, and the sustainability of the business cycle, it's both on an actual basis and also relative to expectations, has contributed to the bull market. Going back into the question, what if employment / payrolls remain strong and the Fed starts cutting rates? Will we not have a double impetus of income and credit driving us into a stronger bull market? So this question, I think, kind of misses the point a little bit. It's a good question. It's a great question. But in terms of answering the question, I think it's important to remember that the Fed doesn't have to cut rates to ease monetary policy. If the market thinks the Fed is going to cut rates, then it's going to price rate cuts into the forward rate curve. And that's exactly what we see. We got about 2 rate cuts priced in for 2024 already. If you look at U.S. money markets, we got about 4 rate cuts priced into 2025. If you look at U.S. money markets. And so those rate cuts are already in the price of interest rates. And as a function of that, they're already in the price of credit instruments throughout the entire fixed income asset class, which is obviously is the primary source of credit creation here in the U.S. economy at about 70%. And so just be aware of that. It's not about the Fed actually cutting the policy rate. It's about the market's expectation of the Fed cutting the policy rate. And we saw this work in reverse back in 2022. If you go back to in late 2021 and throughout early 2022, way before the Fed even started cutting interest rates, and certainly before they started cutting interest rates in an expeditious manner, we saw the forward rate curve, accelerate and tighten policy well in advance of the Fed's actual policy rate increases because of forward guidance. So this is something that's new, not new, but it's more forceful in this market and business cycle than we've seen in previous cycles, which is the impact that forward guidance has on the entire forward rate curve and the likelihood that some elements of the monetary policy transmission have been shortened due to this forward guidance because, again, the Fed can talk the curve in a tighter manner, like we saw in 2021, 2022, and it can talk the curve into a dovish posture, as we've seen throughout 2023 and 2024. So just be aware of that. The Fed's dovish posture is already contributing to the sustainability of the business cycle and the positive surprises we've seen on the economic front over the past kind of 18 months. So just be aware of that. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, June 13th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.